Brad Williams, Frugal Finance, the rate differential swap, the DIF swap. A rate differential swap or DIF swap has payments tied to interest rate indexed in two different currencies, but all payments are made in a single currency. For example, a DIF swap might be structured with all payments in US dollars, with one party paying 3 months US SOFR and the other party paying 3 months Euribor, but with payments in dollars. Assume that both the SOFR and Euribor yield curves are flat, that the dollar rate is 7% and that the euro rate is 6.75%. The payment based on US SOFR might be SOFR flat, and the payment based on Euribor would also be Euribor flat but paid in dollars. As we will see, with currency swap pricing, shows both parties would pay SOFR flat even though the rates are 7% in the US and 6.7% in the EU. This kind of swap would exploit changes in US versus EU interest rates over the tenure of this swap. The cross-index basis note, a cross-index basis note or Quanto note, the investor receives a rate of interest that is based on a floating rate index or a foreign short-term rate, but is paid in the investor's domestic currency. For example, a US investor might buy a note with an interest rate based on European interest rates, but with all payments on the note made in US dollars. From the eye of the investor, the Quanto note provides exposure to foreign interest rates without currency exposure. Also, the Quanto note allows the investor to speculate on relative changes in the foreign and domestic yield curves. From the point of view of the issuer, the Quanto note can offer investors attractive investment opportunities that might not be available elsewhere. Also, the issuer can issue a Quanto note but use swaps to transform its risk exposure to perhaps more congenial form. As an example, consider figure 2210, which shows yield curves for 1 year SOFR in both dollars and pounds sterling. Current rates are 5% in dollars and 8% in pounds. However, the US yield curve is strongly upward sloping, while the British yield curve is even more strongly downward sloping. In this environment, a firm might issue a Quanto note that pays a floating rate equal to 1 year British SOFR plus or minus a spread. Now, I simply replace LIBOR with SOFR. This is purely an example. Just work with it. If it's something else, if it's British, whatever their short-term borrowing rate is, change it. 1 year British, question mark, plus or minus a spread with a maturity of 5 years, annual payments, a principal of $30 million, and with all payments being made in US dollars. The spread on the British SOFR, it doesn't matter if it's British SOFR or British Euribor or something of that nature, would reflect the difference between US dollar and British pound term structures. From figure 2210, it seems clear that British yields are expected to be below US yields for most of the 5 years, even though the initial yield on the British pound is higher. In this environment, the Quanto note will have to pay British SOFR plus a spread to attract dollar investment. Given that the Quanto note will pay British SOFR plus a spread, the initial yield on the Quanto will be more than 3% higher than the floating rate available on a straight US dollar forward rate note. However, the yield curves in figure 2210 suggest that this yield differential is expected to narrow quickly, with British rates even becoming lower than US rates. If the future interest rates correspond to the forward rates implied by the yield curve in 2210, the US investor will soon receive less on the Quanto note than a purely domestic US FRN. Therefore, the investor in the Quanto note has implicit speculation that the interest rates will not converge as quickly or fully as the market seems to expect. On the other side, the issuer of the Quanto note has an implicit speculation that rates will narrow more quickly than the market expects. However, the issuer may wish to offset this risk by engaging in a swap. The first timeline in figure 2211 shows the cash flows from issuing this Quanto note. The principal is in dollars. The amount of each interest payment is determined by the level of British SOFR plus the actual payment made in US dollars. As it stands, the issuer of the Quanto note is exposed to interest rate risk in the US and UK. Here's the example. Here we're using FLIBOR. Just change it to whatever you want. I didn't get to it because it's not that important to me. As I state, this is just old data, but you can use whatever name, whatever information that is appropriate. If this is SOFR, then put SOFR. If it's Euribor, put Euribor. A participant in a diff swap might receive British SOFR plus or minus a spread and pay US dollar SOFR, with all payments being made in US dollars. The spread would reflect the difference in the yield curves for the two currencies. The issuer of our example Quanto note might find a diff swap an attractive hedging vehicle. The second timeline of figure 2211 shows the cash flows on a diff swap in which the issuer receives British SOFR plus or minus a spread and pays US SOFR. The spread in the diff swap and the Quanto note are the same. The diff swap has a notional principal of 30 million annual payments and a tenure of 5 years. The determination of the exact spread on the British pound interest rate requires more information on the exact shape of the two yield curves. Later, we show how to price a Quanto note and its accompanying diff swap. The rate diff swap, as with all swap pricing, the key is to find the terms that equate the present value of the two sides of the swap, consistent with the prevailing term structure. In this diff swap, one party pays British SOFR plus a spread, while the other will pay US SOFR, with all payments on both sides of the swap being denominated in dollars. The present value of the cash flows based on SOFR and US SOFR are as follows. PV SOFR equals summation, and this particular equation times the 30 million divided by a Z O of J, and then looks like we're looking for PV of SOFR equals, and then the pricing solution is to find the value of SPRD that makes these two present values equal. Solving for SPRD gives the following. SPRD, and then we have SOFR, the zero, then the summation of SOFR, and so on and so forth. So we have this 0.33189 down here in the green, minus, and that would be, that's the sum of 0.4905. That would be dollar divided by US dollar zero. So we're looking at this zero minus 0.16381, which is the SOFR forward US zero rate, divided by 4, which is zero coupon US dollar, equals 4.1527. The equation shows that the appropriate spread of the diff swap is 415.75 basis points, which is the same as the spread on the Quanto note. This equation also provides a general equation for the appropriate spread on diff swap. Work through it if you want. Brad Williams, Frugal Finance. Thanks for watching.